Michael Burry is one of the most renowned investors alive today, but he wasn't always an investor. He started off training to be a medical doctor, but did so well just trading his own funds in the markets that people begged him to start a hedge fund, and then the rest, frankly, is history. He has been ridiculously successful, beating every major index and pretty much every other major investor as well, including the dreaded Cathie Wood, for decades on end. He successfully predicted the dot-com crash and made millions doing so. He did the exact same 8 years later with the housing market boom, and in the process of making himself hundreds of millions of dollars then, he made himself infamous as well. For the decade-long period that his hedge fund was open to investors, it made over 500% of returns, while the S&P 500 returned just 3% to its investors. It's no surprise then that a lot of people, myself included, look to him to try and find some kind of guidance to make our way through current market conditions, especially given how turbulent they are right now. Now, over the last 2 years, Michael Burry has found a new rallying cause, a new event to tell everyone about and that he plans on profiting off of as well, and it is of course the market crash that we are currently experiencing. Now, to be perfectly honest, I've spoken about Michael Burry and his predictions regarding this crash countless times over the last year, but on almost every single occasion, I've been widely ignored, and as has Michael Burry. As the bull run rode forward and as investors were making millions from buying overhyped, overpriced tech stocks that had no basis being worth the tens of billions that they were valued at, YouTube commenters love to mock the likes of Michael Burry, claiming that he had predicted 20 of the last 3 crashes and a myriad of other funny little lines. The simple truth is though, 6 months on from the last peak in the S&P 500 and the Nasdaq, no one's mocking him anymore. Now suddenly, everyone is interested in what he has to say and everyone's listening to every word. The simple truth is that Michael Burry was right once again. Once again, he successfully predicted and profited off of a massive market crash. But we're only 6 months into this one, and despite what you may think, that isn't a long time at all. And according to Michael Burry, we are a long way from the end of this market turmoil. So what has he been speaking about recently? What is he warning us of at this time? Well, thankfully, we have Twitter, and in particular his Twitter account, to look to try and answer that question. So today we're going to very briefly look at what Michael Burry has been saying, why he's worried about the economy, and what this might mean for the markets as well. Now this of course starts with the tweet in front of you here, where Michael Burry talks about inflation, and in particular the idea that it was transitory. Transitory, no. Peak, no. To the moon, if you mean a cold, dark place. The CPI news this morning was so awful that it changed the bond market's view of Fed trajectory, and the weakest sector broke. In bond jargon, MBS went no bid, no buyers for MBS. Now what he's talking about here is really quite simple. Earlier on in the month, we got data coming out of the US suggesting that inflation had not peaked, that it's continuing to accelerate, and that is awful news for pretty much everyone in the economy and the markets, because it means that no, the Fed's actions so far have not been sufficient to tame inflation, and so they're needing to go stronger. Now, Burry notes in particular that fixed income assets and bonds are really struggling off of this news. He literally says that the bond market is broken, and it's no wonder why he says that when you look at bond yields over that day, because they absolutely exploded, moving in excess of 30 or 40 basis points over the course of just 8 hours. That kind of volatility is really nothing to turn your nose up about, and it is a sign of a worried market system that really doesn't know how to price what's going to come next. Now, Burry also takes aim at the idea that inflation was transitory all along, or that we've actually seen the peak of inflation, basically making out that they were both delusional, which they were. Now, the reality here is that actually over the last few months, no one has dared to say the words that inflation is transitory, because it's become a surefire way to discredit your position entirely and to let everyone in the world know that you don't know what you're talking about. The real problem is though, most investors and the Federal Reserve themselves have been secretly hoping that their transitory thesis was right anyway. The Fed were pushing back quantitative tightening and interest rate hikes because they were hoping that inflation would ease on its own. Investors continue to pile money up into overhyped tech stocks because they continue to hope that inflation was actually transitory and that it would die down on its own. The last CPI data that we got, unfortunately, was the straw that broke the camel's back. There is now no possible narrative surrounding that makes any feasible sense. Inflation was not transitory, it never was, and so the only way to bring it back down to sensible levels is for the Fed to crash the economy and the market. Next, we see Michael Burry talk about the economy that actually the Fed is likely to crash. US personal savings fell to 2013 levels, the savings rate to 2008 levels, while revolving credit card debt grew at a record-setting pace back to the pre-COVID peak, despite all those trillions of dollars of cash dropped in their laps. Looming a consumer recession and more earnings trouble. Now, along with those words, Burry showed us some graphs, some data which show that savings levels are down to decade-long lows. And this is at a time when the economy is still in turmoil, which means that when people start to lose their jobs, they're going to have less money than usual to fall back on before things start really going awry. He also noted how saving rates are at lows not seen since the Great Financial Crisis, when the Great Recession was in full swing. That means that this problem of low savings isn't going to get better anytime soon either. And then finally, he takes note of the fact that credit card debt is growing at record all-time highs. And that's again a sign that actually the economy is far weaker than people would have you believe. The simple fact is that consumers are in a really poor position. They're in a weak position. They don't have much cash in their bank accounts, and every month it isn't really growing. Debt, on the other hand, is growing at a pretty monumental rate, in particular credit card debt, which already has a high interest rate, but which is going to absolutely explode as the Fed continues to hike the federal funds rate over the next few months. This is basically a recipe for a recession because there's just no way around it. Consumers do not have the money to spend anymore, and that's only going to get worse. They're going to have less money in the future, which means that companies' earnings are going to take hits and thus their valuations as well. In short, Burry is saying that actually the stock rout is not over because earnings haven't even really started to take an impact from the poor economy that they're operating within. As it becomes harder and harder for a company to earn a profit off of a struggling consumer, stock values will only continue to decline. Next, Michael talks about the idea that actually this isn't going to be a quick process and it's going to be dragged out. The theatre took more than a decade to overstuff. It's not likely everyone gets out in less than a year. It's often forgotten these days, but quantitative easing started post the Great Recession back in 2008, not post the COVID pandemic of 2020. So much focus is applied to the last 2 years because it has been an acceleration, but actually the bull run that has been fueled by this mass liquidity and federal money printing has lasted over 10 years, not just 2. What does this mean from Michael Burry's point of view? Well, we're likely going to see valuations of equities return not to their pre-COVID 2020 levels, but maybe even their 2010 levels back before the economy became flooded with such excess liquidity. The crash here will probably take a long time to do this as well, and the reality is that this is always the case. You probably just have a wrong idea of how bubbles really work. The word bubble itself gives us this idea of an asset class growing and growing and growing until it finally can't take it anymore and it pops and collapses over the course of a couple of days. The problem is, though, that never actually happens. The dot-com bubble, which absolutely no one in the world will tell you wasn't a bubble, took about 3 years to actually deflate. The 2006 housing market bubble as well took about 2 years to entirely deflate. We're only 6 months into this bear market, and so it is without a doubt not going to end anytime soon. Next, Burry reiterates the idea that actually getting things right is really difficult, especially with market conditions being so turbulent. Just getting one thing right is hard. The 1999 tech bubble, the 01 to 05 value revival, the 2005 housing bubble, 2009 almond farms, 2020 COVID bottom, 2020 lockdown horrors, 2021 meme stocks, 2021 crypto leverage, 2021 inflation, 2022 not done yet. What's to come for 2022? The simple fact is here that it's incredibly hard to predict the future, and even Michael Burry isn't sure what's next. Are we going to see a standard recession of a couple of years of tough growth and low asset prices, followed by another boom cycle? Are we going to see a stagflation recession where inflation maintains its extremely high levels, which puts massive limits on what the government can do to try and aid growth? Are we going to see an instant and swift return to quantitative easing and another liquidity-fueled asset bubble to follow? Or are we going to see a Japanese-style lost decade where American equities fail and struggle for years on end? The simple truth is that Burry doesn't know here, I don't know here, and neither does any other investor out there, but the data suggests that it isn't going to be good. Finally then, Burry has this to say. As I said in 2008, it's like watching a plane crash. It hurts, it is not fun, and I'm not smiling. The simple fact is that Burry got a lot of flack after 2008. During the run-up to the actual financial collapse, his own investors tried to mutiny against him and exit his short positions. He made them millions of dollars, some of them hundreds of millions of dollars, and yet they still came out of this hating them altogether. Everyone else in the world, though, hated him because he didn't warn them enough, apparently, because he allowed the bubble to continue to grow while he set bets against them. The simple truth is, though, he did warn people about it, they just chose to ignore him. Now this time, though, he's doing more. He is tweeting a lot. He is letting everyone know his thesis and his ideas and his trades. And so this time, no one should be able to, in good faith, claim that he isn't warning them. But unfortunately, people still choose to be ignorant, especially when it comes to Michael Burry. Now, I've spoken about Michael Burry quite a lot on this channel, but this is the first time I've spoken about him over the last few months, while he's pretty much been confirmed as categorically right about calling the last market bubble and the current market crash. This here is the comment section from a video I made about Michael Burry about 7 months ago, right before the markets peaked and before they started their downturn. Some of the most upvoted comments on this video are people mocking Michael Burry, fundamentally misunderstanding what he's actually saying, constantly saying it's going to crash and eventually you'll be right. The simple truth is that this person expects a day of declines where 90% of every asset class in the world collapses overnight before markets start to rise again. They expect a specific minute and hour and day for this trigger, and if you give them anything less specific than that, they'll claim that you were wrong anyway. These people complain that some predictions for these crashes were early, some even as early as 18 months prior to the actual decline. They make frankly weird statements about what people are claiming, saying that actually they've been calling for a separate crash every week for an entire year, when in reality, Burry has been calling for one major crash for about 18 months long. The idea that markets grew and grew and grew up until this crash didn't prove him wrong, it proved him even more right, and it just meant that when that crash finally came, it was just going to be so much damn bigger. The reality is that we are now in that crash. The people who ignored Michael Burry before are the same people whose portfolios are hurting today. I exited my risk on asset positions in US equities back in December, and actually in the two worst parts of December, first when markets dipped early on in the month, and then again about on the 20th of December, missing the top of the markets by about 5%. Compared to the bloodbath that has now followed over the last 6 months though, I still got off incredibly easy. The reality is that you don't need to time the top of the market, you just need to be able to get back in at a lower cost average than when you left, and that's something that Michael Burry could clearly accomplish. If you enjoyed this video, then make sure to like, comment and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.